In 1963, American Express was caught in one of the strangest corporate scandals in Wall Street history. A subsidiary had issued warehouse receipts certifying millions of dollars worth of soybean oil that, it turned out, did not actually exist. The fraud was so large that American Express faced potential liabilities that could have bankrupted the company entirely. The stock collapsed nearly 50% in weeks. Every major institutional investor sold. The financial press called it one of the most reckless corporate failures of the decade. Warren Buffett did something that looked insane at the time. He took 40% of his entire investment partnership's capital, nearly $13 million, an extraordinary concentration for any investor, and bought 5% of American Express. Today, Berkshire's American Express position is worth over $4 billion in dividends alone, plus a stake currently valued at more than $40 billion. In this video, I'm going to walk you through the 5 reasons Buffett made this bet, the analysis that let him see past a genuine corporate scandal to an opportunity almost nobody else could identify. Reason 3 is the one that reveals the single most important skill Buffett used that day, a skill that has almost nothing to do with financial statements. Stay with me. Let me explain exactly what happened, because the details matter. In the early 1960s, a commodities trader named Anthony De Angelis ran a company that traded soybean oil. To finance his trading, he used warehouse receipts as collateral documents certifying that specific tanks contained specific quantities of oil. A subsidiary of American Express called American Express Field Warehousing Corporation was responsible for inspecting and certifying those receipts. De Angelis had discovered a way to deceive the inspectors. Some tanks contained mostly seawater with a thin layer of oil floating on top, enough to pass a surface inspection while the bulk of the certified inventory simply did not exist. When the fraud was discovered in late 1963, the scale was staggering. De Angelis had used these fraudulent receipts to secure loans and trading positions worth hundreds of millions of dollars. American Express, as the certifying warehouse company, faced potential legal liability for certifying oil that was never actually there. The stock market reacted exactly as you would expect. Investors had no way to know how large American Express's actual liability would be. Estimates ranged from tens of millions to potentially company-threatening sums. The uncertainty itself was enough to crush the stock. It fell from around $65 to the low $30s, a decline of roughly 50% in a matter of weeks. Buffett, running his investment partnership from Omaha, watched this unfold from a distance most Wall Street investors did not have emotional distance. Here are the 5 reasons he concluded the market was wrong. Separating the scandal from the business. What Buffett saw. The first thing Buffett did was something most panicked investors fail to do during a crisis. He separated the scandal, which was real and which created a genuine financial liability, from the underlying business, which was the part of American Express that had nothing to do with warehouse receipts. American Express's core business was its charge card and traveler's checks operations. That business had no involvement in the salad oil fraud. Cardholders did not stop using their American Express cards because of a warehouse certification scandal. Travelers did not stop trusting American Express travelers' checks because a commodities trader had defrauded a subsidiary. The scandal was a liability question contained to one subsidiary. The core business, the actual engine that generated American Express's profits, was untouched. Why it mattered? The market, in moments of crisis, often fails to make this distinction. When bad news hits a company, the stock price reflects fear about the entire enterprise, even when the negative event is isolated to a specific division or liability that does not touch the core operating business. Buffett's process was methodical. He personally visited restaurants and retail establishments in Omaha and asked merchants whether the scandal had affected their acceptance of American Express cards or their customers' usage patterns. The answer consistently was no. People were still using their cards. Merchants were still accepting them. The actual business, as measured by actual customer behavior, was completely unaffected by a scandal that was dominating financial headlines. What you look for. When a stock crashes due to bad news, ask, does this news affect the actual operating business that generates revenue, or does it affect a contained liability that is separate from day-to-day operations? If customers are unaffected and the core business continues generating cash flow normally, the crash may be a price event rather than a value event. Reason 2 is about quantifying the actual liability, and the specific math Buffett did that most investors at the time never bothered to attempt. Doing the math nobody else was doing. What Buffett saw. Most investors who sold American Express stock did so based on fear and uncertainty about the maximum possible liability, without actually attempting to calculate a realistic estimate. The market was pricing in something close to worst-case scenarios. Buffett approached the liability question analytically. He researched the actual scale of the warehouse receipt fraud, the realistic legal exposure American Express faced as the certifying party, and the company's capacity to absorb that liability given its underlying earning power and balance sheet strength. His conclusion: even under a reasonably severe liability scenario, significantly worse than what eventually materialized, American Express's core business was strong enough to absorb the loss and recover. The company was not facing bankruptcy. It was facing a large, painful, but survivable financial hit. Why it mattered? The eventual settlement, reached in 1965, was approximately $60 million. A large sum at the time, but well within what American Express's ongoing profitability could absorb without threatening the franchise. The market's worst-case pricing had been an overreaction driven by uncertainty rather than careful analysis of the actual range of probable outcomes. This is a recurring pattern in market overreactions. Uncertainty is often priced as if it were maximum negative certainty. The investor willing to do the work of estimating a realistic range of outcomes, rather than reacting to the scariest possible headline, frequently finds that the market has overshot. What you look for. When a company faces a legal or financial liability that is creating uncertainty in the market, attempt to estimate a realistic range of outcomes rather than assuming the worst case. Compare that realistic range to the company's earning power and balance sheet strength. If the company can clearly absorb even a pessimistic outcome and continue operating, the market's panic-driven price may not reflect the actual risk. And now reason 3, the one that reveals the actual skill Buffett used that day, and it has almost nothing to do with reading financial statements. The scuttlebutt method, research that Wall Street ignored. The peak insight, what most people miss about this story. The single most important piece of research Buffett conducted was not financial analysis. It was something investment writer Philip Fisher had called the scuttlebutt method, gathering real-world information through direct observation and conversation rather than relying exclusively on financial statements. Buffett sent associates and reportedly visited himself to restaurants, hotels, and retail stores in Omaha and beyond to directly observe whether the American Express card was still being accepted and used. He asked waiters whether customers were still paying with American Express. He asked retail clerks whether card usage had changed. He observed, firsthand, whether the scandal had created any actual change in consumer or merchant behavior toward the brand. Why this was the decisive insight. Wall Street in 1963 was almost entirely focused on the legal and financial dimensions of the scandal, the liability calculations, the lawsuit exposure, the balance sheet implications. Almost nobody was asking the simpler, more fundamental question: is the actual underlying business, the charge card franchise, still functioning normally? Buffett's scuttlebutt research answered that question definitively. The franchise was intact. Cardholders trusted American Express for what it actually did: facilitate payments and provide travel services. They did not associate that trust with an unrelated warehouse subsidiary's fraud exposure. The brand's core value proposition, trust and convenience in payments, was completely undamaged by a scandal that had nothing to do with payments. This is the insight that the purely financial analysts on Wall Street missed. They were doing balance sheet math. Buffett was doing behavioral research. And the behavioral research told him something the balance sheet alone could not: that the franchise value, the part of American Express that actually generated long-term earning power, was fully intact. What this teaches: financial statements tell you what happened. They do not always tell you whether a brand's underlying value with its actual customers has been damaged. When evaluating any company facing reputational or scandal-related pressure, go beyond the financial analysis. Talk to actual customers. Observe actual behavior. Ask whether the people who generate the company's revenue have changed how they interact with it. That direct, observational research is frequently more valuable than anything available in a quarterly filing. and it is almost always something the broader market has not bothered to do. Reason 4 is about the moat Buffett identified in American Express, one that explains why the brand survived the scandal and every challenge since. The trust moat, why the brand was bigger than the scandal. What Buffett saw. American Express's core franchise, the charge card and traveler's checks business, was built on a specific and durable moat, trust. When a merchant accepted an American Express card, they trusted that American Express would pay them. When a traveler carried American Express traveler's checks, they trusted that the checks would be honored anywhere in the world, and that if lost or stolen, American Express would replace them. That trust had been built over decades. It existed independently of any single subsidiary's behavior. The salad oil scandal was, fundamentally, a failure of a warehouse inspection business, a relatively small and unrelated part of the American Express corporate structure. Why it mattered. Buffett understood that brand trust, once established at scale, is remarkably resilient to events that do not directly touch the customer-facing promise. American Express's promise to cardholders and merchants was about payment reliability, not about warehouse certification accuracy. The scandal, however embarrassing and costly, did not undermine the specific promise that customers actually cared about. This is precisely the kind of moat analysis Buffett would apply decades later to Coca-Cola, to Geico, to See's Candies, identifying the specific, durable promise that creates customer loyalty and distinguishing it from peripheral business activities that do not touch that promise. What you look for. When a company faces a scandal or crisis, identify the specific promise the brand makes to its core customers. Then ask whether the crisis actually violates that specific promise, or whether it occurred in a peripheral area that customers do not associate with the core value proposition. A bank that mismanages an unrelated investment fund is different from a bank that fails to protect customer deposits. The distinction determines whether the moat has actually been damaged. And the final reason, reason 5, is about conviction and concentration. Why Buffett bet 40% of his entire fund on a single scandal-ridden stock. Extreme conviction, betting big when the math is clear. What Buffett did. Most investors, even those who agreed American Express was undervalued, would have allocated a modest position, perhaps 2 to 5% of their portfolio. Buffett allocated approximately 40% of his investment partnership's total capital to American Express. This is one of the most concentrated bets of his entire career, before or since. It reflects a principle that he and Munger would later articulate explicitly. When you have done the analysis, when the math is genuinely clear, when the downside is limited and the upside is substantial, bet big. Diversification across mediocre ideas is not a virtue. Concentration in a rare, high-conviction opportunity is how exceptional returns are actually generated. Why this was possible. This level of concentration was only rational because of the depth of analysis behind it. Buffett was not betting 40% of his fund on a hunch or a hot tip. He had separated the scandal from the business. He had quantified the realistic liability. He had conducted direct behavioral research confirming the franchise was intact. He had identified the specific trust-based moat that remained undamaged. Each layer of analysis reduced his uncertainty and increased his confidence. By the time he made the decision, he was not gambling on an unknown outcome. He was making what he considered a highly probable, well-understood bet that the market had mispriced due to panic and incomplete analysis. The position appreciated significantly over the following 2 years as the scandal resolved and the actual liability proved manageable. It became one of the foundational successes of his early investing career, and a model he would apply repeatedly throughout his life, most notably decades later, when Berkshire built its largest ever position in American Express stock, a position it still holds today. What this teaches. Position sizing should reflect conviction, and conviction should be earned through genuine analytical depth, not assumed from enthusiasm. Most investment opportunities deserve modest position sizes because most analysis contains significant uncertainty. The rare opportunities that deserve large position sizes are the ones where multiple independent layers of research all point toward the same conclusion, and where the downside is genuinely limited by a thorough understanding of the worst-case scenario. Those opportunities are uncommon. When they appear, Buffett's career suggests that timidity is the greater risk. 5 reasons. 1 scandal. One of the defining early investments of Buffett's career. Let's bring it together. Reason 1. He separated the scandal from the business, recognizing that a contained liability in one subsidiary did not necessarily damage the core franchise. Reason 2. He did the math nobody else was doing, estimating a realistic range of liability outcomes instead of pricing in the worst-case scenario, as the panic market was doing. Reason 3. He used the scuttlebutt method, direct behavioral research with actual customers and merchants, revealing that the franchise was completely intact when Wall Street was only looking at balance sheets. Reason 4. He identified the trust moat, understanding that American Express's specific promise to customers was about payment reliability, not warehouse certification, and that the scandal never touched that promise. Reason 5. He bet big when the analysis was clear, allocating 40% of his fund because multiple independent layers of research all confirmed the same conclusion. This story, more than almost any other in Buffett's career, demonstrates that his edge was never about having information nobody else could access. The scuttlebutt research he conducted, visiting restaurants, talking to merchants, was available to literally anyone willing to do it. The edge was the willingness to do the work that the panicked market was not doing, to separate fear from fact, to quantify uncertainty instead of reacting to it, to bet with conviction once the analysis was genuinely complete. That is the same framework applied to a soybean oil scandal in 1963 that he would later apply to Coca-Cola in 1988 and American Express again at far larger scale decades later. The next video in this series is a different kind of comparison, not Buffett against another investor, but Buffett against his own business partner. Charlie Munger and Warren Buffett worked together for over 50 years, built one of the most successful companies in history, and almost never thought about problems the exact same way. Understanding that creative tension is the focus of the next video. That video is right here.